Okay, welcome everyone to the first session of Bernstein India Quant Series Season 2, where over the next 3 weeks through 5 sessions, we would talk to different fund managers in India to get their perspective on various aspects of quant investing with respect to Indian markets. We are planning to actually come back with similar sessions early next year, so stay tuned for that as well. This series, we believe, is equally interesting for not just quant investors, but equally for fundamental investors, because it gives a different perspective of looking at the markets, and especially listening it from your own peers. In fact, in some instances, what we have found is that investors have not necessarily given it a quant-only approach, but have actually blended it with their fundamental frameworks. And I would say our first speaker fits that category very well. We are very pleased and honored to start the session with Harish Krishnan, who is the Senior Fund Manager from Kotak Mahindra AMC. Harish has close to 2 decades of experience spread over equity research and fund management. Prior to joining Kotak Mahindra Mutual Fund, he was based out of Singapore and Dubai, managing Kotak's offshore funds. Harish has also worked at Infosys in his earlier stint. He's a Bachelor of Technology, Electronics and Communication from Government Engineering College, Trichy, a postgraduate in management from Indian Institute of Management, Kozhikode, and a Chartered Financial Analyst from CFA Institute. Harish would be spending the next 30-35 minutes taking us through his presentation, followed by a fireside chat with me for the next 15-20 minutes, post which we will open it up for wider Q&A. With the session link, you would have also received the Pigeonhole link, which you can actually use to put in your questions or vote up some of the existing questions that you have. With that, I will actually hand it over to Harish to take us through the first principles approach of quant investing in India. Over to you, Harish.
Hi, thank you so much, Rupal. I'm just checking whether the screens are shared at your end as well.
Yes, it's visible.
Great. So thank you. It's quite fascinating and a privilege to start up your season on quant investing from a practitioner lens. So at the outset, let me say that I'm a quasi quant, or a quack quant, brought up from fundamentals. So for well about 18 odd years, been with markets with Kotak Group. And over the last 4-5 years is when my journey in quant, took off. And part of some of what I'm going to share with you is our thinking of quant, some of the practical challenges that we face as practitioners coming from an India-specific context. And I'll describe in some depth as to what we think are the bigger challenges, and how we look at from a framework point of view, addressing few of them over the course of the next few slides. So in some sense, I'm a big believer of first principles investing, and therefore we've gone about designing and devising the entire quant framework from a first principles approach. So purely from a problem statement point of view, these are the 3 broad dimensions that money managers globally as well as in India go through. And the 3 dimensions are insight, repeatability, and cost. So if you look at the traditional lens of investing, which is the active basis, say fundamental signals, broadly, there's definitely a lot of proprietary insights that one brings in. However, it's subject to significant emotional biases, and we all have gone through it time and time again, both in terms of our own biases as well as in terms of how repeatable our own reactions to some of the same events unfolding can vary quite meaningfully. And which brings me to a third point, that repeatability, um, given a certain set of conditions, tends to be quite poor, given the fact that discipline, etc. Of course, I'm not saying that all active managers are like that, but there's a gradation of each of these three dimensions, which is where I guess active has kind of had its own set of challenges. On the other extreme of the prism is clearly the passive strategies, wherein there aren't any proprietary insights. These are primarily, mostly market cap weighted, or you've got some kind of additional layers in the form of free float, liquidity, et cetera, which means that there is zero proprietary insights. Invariably, I'm not saying it's true for everything, but invariably cost is the primary determinant. There are some significant liquidity constraints that come through, especially in the Indian context, and I'll cover this in quite some depth as we go in the next subsequent few slides. Not to mention the reputation challenges, given the fact that the entry point is primarily market cap and free float in some cases. It does run a possibility that, certain quote unquote poorly conceived or poorly perceived corporate governance institutions do make up that rank, which can have its own set of challenges. The good thing, of course, is that it's got very high repeatability, which means that come again, you run the same strategy, a similar kind of an input and a similar kind of an output. Our thinking on using Quant is primarily to combine the best of both of these, and which is what we think that man plus machine is greater than either man or machine. And therefore, our thinking of Quant has primarily been to arrive at proprietary insights, which are profitable, of course, which seek to reduce some biases and therefore are repeatable. More importantly, one can get a sense as to under which conditions the broader signals are likely to fail. And more importantly, when the conditions are favorable, one can expect a reasonable amount of repeatability in terms of performance. More importantly, I think given the wealth of experience that a lot of us have, it will be it will be of a greater advantage if you use a lot of fundamental and more importantly behavioral insights that can dramatically lower the reputation risk. I'm not talking about just removing a particular stock A or B from a back test just because post everything happening out, you get to you have a sense that that stock wasn't of the best corporate governance, etc. But to have behavioral insights to remove that, and that can have a meaningful edge in terms of actual implementation of a lot of these quants. Of course, the perception is one thing. More importantly, it also leads to better risk-adjusted performance, which is what we are all in this business for. And more importantly, I think these kind of active, passive, or whatever you want to call it, rule-based investing is the way I like to call it, can actually adjust to the Indian conditions basis liquidity quite meaningfully. So this is broadly our kind of the fulcrum, the way we look quant at from the lens of, and we tend to use quants broadly in two frameworks. And the first framework, which we call it as quant assisted fundamental. Now, here our primary focus is that the quant comes as an alternate data point to measure risk. So it is more a top-down kind of an approach. The idea is that can we get a sense of the feedback loops of the market, and can we use that feedback loop to either increase or to decrease risk, both in terms of our own thinking, at least at the back of our minds, and also in terms of implementation, say, for example, in asset allocation frameworks, wherein we may want to increase or decrease, say, exposures to particular sectors or to particular asset classes. And the primary motive is to look at aggregate data points, top-down indicators like market structure, distribution patterns, volume analysis, stuff like that, which over long term tends to be mean reverting. And that's primarily the key use case that we look at when we look at quant assisted fundamentals. On the other side is basically fundamental assisted quant or FAQ. Here, obviously, through factor investing or other approaches, you're basically looking at devising a system which can do end to end from input to output to weighting to rebalance to execution in that order to try and create a solution that comes out to it. As we all know, pretty much while there is a significant increase in the power of compute, it is primarily GIGO, garbage in, garbage out. And therefore, it is very important and pertinent that we use the fundamentals and the behavioral insights that we have in devising the rules that go into devising the system. And here, at least our thinking is that common sense trumps complexity anytime. And therefore, for us, things which are intuitive, which makes fundamental sense, can help us in devising the edge conditions or the boundary conditions that then can go into devising the broader rules. And I'll touch both on both of these aspects in the form of some nuances and some frameworks in the slides ahead. This is, I think, an important illustration that, to me, explains a lot about quant and markets. And of course, while this is a philosophical slide, at the end of the day, we all know that this is a probabilistic exercise, and the path that one chooses could be the start of multiple other paths, which could also culminate into multiple other ends. And therefore, given the fact that just one path is chosen, to have that as the basis for gaining conviction in your system, I think is prone to significant errors. And I'll speak to it specifically when I come to backtest and the issues that we find in backtest. But this, to my mind, is primarily how we look at probabilities in investing. That at any point of time, obviously, the options and the ranges that one can see through are just immense. And therefore, let me now move on to some of the indicators, and these are data points that we've shared in public, so we're bringing it out as part of this presentation. But these are some of the many feedback loops, and I'm not going to spend a lot of time over here, but just to get a sense as to how we look at moving up and down the risk curve over multiple such indicators. And this one is, of course, the multi-bagger count, stocks which have gone up 2x, 5x, 10x in a span of 5 years. And if you look at this blue line, which is obviously the most amplified, which is stocks which have gone up 2x over 5 years, I guess one gets a sense of how the overall breadth of the overall markets are and how people have made reasonably good returns over multiple cycles. And of course, on the right side is the similar set of universe sliced down into various buckets of ROEs and PAT profiles or earnings profiles. And what we can see it is that clearly with time, both the aggregates, ROE is greater than 20, PAT greater than 15, or ROE is greater than 15 and PAT CAGR greater than 10, have tended to decline. So therefore, in one sense, one can get a sense that, despite this happening, we've seen a similar sense of doublers, though clearly in terms of 5x and 10x, it has come off quite meaningfully. Another set of feedback loops, this one is the percentage of stocks which have outperformed NSE 500 in the last 1 year. And again, it's a reasonably mean reverting indicator. Of course, the nemesis of most active investors is this one in 2018-19, wherein a significantly lower fraction of stocks actually outperformed. But by and large, it's a reasonably consistent mean reverting indicator. This is another interesting thing that we figured from a behavioral point of view. Basically, this is a plot of the number of stocks within a universe which is close to its all-time highs, defined as 99 percentile lifetime wealth of these stocks. And again, you can get a sense that, how mean reverting this is. These are all data points over the last 20, 25 years. So one gets a sense that, for example, not too long ago, in June, July of 21, more than the majority were actually experiencing all-time health. Generally, as you can see in this plot, roughly about 20 to 25% of the stocks move. So even as index makes all-time highs, generally only about 20, 25% of them move along with the index. And of course, at some points of time, it goes up all the way to close to about 50%. And at other points of time, it's closer to about 0%. So this is again a contrarian or a mean reverting signal that we can potentially look at from the lens of top-down investing. Again, on the data point, out here in terms of valuation, and India has seen a significant explosion in the form of valuation skews over the course of the last 4-5 years, especially post 2016. And while there are many reasons attributed to the same, and I guess the reality is that we've seen a significant inch up of very high valued companies. So one metric that we look at is the price to sales greater than 10x, which in arguably one can say is that of extremely high valuations. Right. And basically, this is a plot of both the number of companies, the percentage of market cap, which is in this red or orange line, and also the amount of turnover or the cash trading that's happened on those set of names. And as you can see, post COVID also, the percentages are extremely high. These are typically more a function of fringe behavior, wherein 5-10% of overall market could be in such high valuation zones. But now we are in the realm of close to about 20% or so, which are in such high valuation zones on an absolute framework. More importantly, they are just not, typically quote unquote cornered stocks. They're also getting traded significantly and getting quote unquote distributed over the past many quarters. So these are various measures that I've given in the form of top-down risk assessment through looking at market structures, etc. Of course, a lot of them we've already spoken in public forum, and therefore we've shared there are a whole bunch of other indicators that we have not yet presented. But I guess you'll get the drift of what we look at when we look at how we use this in terms of our traditional investing approaches as well. Coming to the other aspect, which is the fundamental assisted quant. And this is a great quote. I think I'm not remotely even suggesting that quant is science fiction, but inevitably good science fiction predicts the car. Great science fiction predicts the traffic jam. And I guess, when we keep reading up literature on Zoo Library and the preponderance of so many back tests and how it's become so easy for anybody to come up with a factor, to come up with what seems to be great. But when we look at actual, practical deployment of many of those strategies, there seems to be a huge difference between what was promised and what finally gets delivered. And I think part of the reason is that, I guess the traffic jam aspect of what happens when, a lot of these factors get mainstreamed, etc., is something that I think one needs to think about right at the time of designing many of these factors. So which brings me to, I think, the biggest challenge as far as devising or designing quant systems in India, which is the fact that in India, while it's a reasonably deep market, a lot of stocks, 5,000 stocks which are listed, etc., and where there's a lot of retail participation. The reality is that bulk of the liquidity, or almost all of the liquidity, has gone onto the F&O side. The cash market volumes are actually quite poor. Stocks where one can execute trades of 50 crores, which is what about $7-8 million, assuming even a 25% participation is close to about 70-80 names, and that is after this big rally that we've seen in the last 2 years. Before that, it used to be as low as about 20 names. Now, how do you arrive at or how do you devise a strategy which can, for example, be say a 2,000 or a 5,000 crore AUM in a quant devised thing, wherein even 1%, if you have to execute it on one particular day of rebalance, there is going to be meaningful slippage. And of course, over time, I'm sure liquidity will improve, etc. But how do you kind of incorporate this in terms of the overall broader implementation framework is something I think a lot of focus needs to be kept at right at the start itself. Similarly, if you look at some of the bigger challenges that we find in India, clearly, when we look at data, and we can talk about both fundamental data as well as other aspects, a lot of good quality data is available only post 2005. In fact, even the index levels, etc. I'm sure some of you may be aware that, for example, while one can claim that Sensex has given so much returns in 79, etc., almost the data points from 79 to 90, 95 are anybody's guess. It's only post that we have actually some evidence that on a daily basis what the NAVs of Sensex, etc. is. I'm not saying it's only a question of Sensex. What I'm trying to say is that this is true for a lot of data points in India that, for example, earnings estimates, surprises, a lot of them are effectively useful only in the last 10 years or so. Which brings me to the second observation that, what has worked post GFC has been one broad style, which is that capital efficient businesses have been rewarded well. And therefore, there haven't been too many cycles to actually test the back test on effectively. Unlike, say, US, wherein we've got almost, say, 70, 80, 90 years of data, wherein depending on different macro environments, depending on different business cycles, one can actually see how various factors, etc. Have kind of moved. Out in India, we've just got basically a 10, 12, 13-year history of good data, wherein one can see, and in that it's been predominantly one cycle or one broad trend that's played out. And therefore, this is something that it's open to debate, at least to my mind. The typical way of in-sample, out-sample quant testing. I'm not so sure in India. It's something which I'll have a lot of confidence on, given the fact that I mentioned that it's part of a bigger trend rather than significantly other cycles. Of course, that doesn't mean that we give up. There is enough academic literature out there which clearly goes on to say that factor investing works. But the idea is to come up with frameworks so that we have greater confidence in what we are proposing, that can actually work out in the real world. And so the idea is to look at these multiple frameworks, and we work with about 5 or 6 of them uh, to get greater confidence in some of the work that we do, and more importantly, to discard a whole bunch of things that we think won't make the cut. And so some of the ways in which we've gone about doing it is we focus on the lowest common unit cycle, which is a 60 trading day. Of course, it's open. Somebody else may have it 120 trading day, 30 trading day. It depends from style to style, algo to algo, signal to signal. But for us, we don't focus on terminal Kagers at all. There are, in fact, what we've seen is that sometimes overlooking the terminal Kager has actually worked out much better when we look at the lowest common unit cycle, which in our case is a 60-day profile, wherein we look at how various strategies stack up to in terms of return, risk, churn, sharp profiles, etc. The second thing that we look at is to run all of our strategies on a rolling starting date point of view. And therefore, a single strategy running, say, with 250 different starting points with 60 different unit cycles, in our mind, can generate a significant amount of different cycles behavior. Of course, they are smaller cycles, and therefore, within that context, one is able to get a better sense as to which are the strategies that are definitely standing out and which are the ones that are just about average. And then, of course, we look at the median of that. The other things that we do, and I'll speak about it in a while, is to run random strategies, and I'll cover that in on the slide. Um, the other aspect that we do is run hindsight best and worst portfolios. So let me quickly tell you what we mean by that. Of course, from a given universe, and whatever be the universe that you're drawing in the overall signal from, we for a particular rebalance period, we run what the hindsight best and the hindsight worst portfolios will be at on any given point of time. And if the signal is truly useful, then ideally it should be having in your portfolios more of the hindsight best and less of the hindsight worst. And therefore, over a period of time, if you've got greater confidence that this ratio of hindsight best to worst in your signal is also tracking out quite well, it gives you some greater confidence that the signal that you track is reasonably good to go in the real world as well. Something similar is the hit rate between rebalances, especially in a lot of rebalance wherein the frequency is quite high. The hit rates tend to be between 50, 55, 60%. You don't want, even though, clearly Quant works on power laws, and you expect, the ones that outperform to do most of the heavy lifting. You don't want a very low hit rate at 20, 30% and just allowing the power law to do all of the heavy lifting. So again, this is something that you can that we look at internally in terms of identifying which are the factors or which are the signals that have a reasonably good consistent hit rate and therefore can hopefully perform well in the real world as well. And lastly, this is a paper that I've written along with Mr. Rajan Raju, which is on factor investing in India, on factor exposures and style analysis. And I'll cover this in a subsequent slide. So a combination of, in short, what I'm trying to say is a combination of these 5, 6 different approaches, rather than just purely relying on one backtest data, is what we think helps us identify some of the factors or some of the signals which we think can potentially come good in the real world over multiple cycles and times, and more importantly, helps us discard a lot of factors and strategies which we think are unlikely to make the cut in the real world. Um, Coming to backtest, it's possibly one of the good things and the bad things of Quant. Obviously, it's much better than narrative-based selling, but the reality is also that backtest is just one instance. So what I've shown here is for the same strategy, nothing changes. The only difference is the starting points, and they are all in 2005. We just took out, I think in this case, 10 random starting points, I guess, some in Jan, some in March, et cetera, et cetera. And over the course of the 15 years or 17 years since it went live, that's a huge gap in terms of course, this is the terminal CAGR. But even if you were to look at the right side on the 3-year rolling return, the green area is basically the difference between max and min of the 3-year plot, and it's quite big, right? There are times where it's almost a 10% CAGR difference between the max and min, and the only difference being that the starting points that one chose just happen to be different. And therefore, I guess it is important, and especially when one is presented one benchmark backtest NAV, wherein there is nothing else given, right? Firstly, is that backtest truly reflective of the overall strategy? We don't know. More importantly, we don't know whether returns from this backtest therefore will stack up to the real world, and therefore it is important to not get carried away just by the return based analysis, which is what we wrote in our paper. The link to the paper is out here. But broadly, we and the way we've gone about doing it is firstly to do a full factor regression. Some of you may be aware that just like the pharma French factor library, IMA has an academic factor library. Of course, the issues that we've faced is that they're not really updated with the frequency that we love. Thankfully, Rajan Raju, who is the author of this paper along with me, he's been kind enough to publish his entire factor library online. This is the link to the factor returns. So effectively, these are academic factors. They are long, short, and long only factor returns, 5 factor, 6 factor, etc. So we run a full factor regression out of that. Then we estimate what is the factor efficiency ratio basis this. We then go about identifying the return-based style analysis. The paper has all the details. I'm not getting into it because of the paucity of time. And then depending on the strategy, is it long only, is it a particular large, is it large and mid, etc. One can do the third level of regression to isolate the factors and then to arrive at a triangulation methodology. So without boring you with the details of the analysis, I'm sure for those who are interested can look it up in the paper. I think the reality that we see is that in a lot of factor indices that are in the public markets, for instance, the factor efficiency ratio is actually quite poor in as far as the Indian indices are concerned. It's not to say that they're not there, etc. So don't get me wrong, they are definitely there, but it's a lot less represented. So we'd run the same exercise, though it's not part of the paper, for the US factor indices, and that had a significantly higher factor efficiency curves out there. But I think it's a good start, but one shouldn't blindly believe the labels of the indices to believe what is that. For example, we found it quite funny that the value index of one of the index providers actually had no value factor of statistical significance. It had a whole bunch of, and no doubt that factor was doing so well from 2010 to 2019, even before value was in vogue. But the reality was there was nothing as remotely close to the value factor which we found there. And more importantly, whenever there are these, multi-factor indices which try and combine 2 or 3 factors, what we've invariably found is cramming 3 or 4 factors in 30 or 50 stocks doesn't do justice to anything. And therefore, it's better off to have 3 separate factor indices and then to combine them than to have one consolidated portfolio of say 50 stocks and hoping that that will work its magic. But the limited point I'm trying to bring is that this is a good exercise to get to know where your strategy scores up to, and more importantly, I think where when you look at other indices or other benchmarks, etc., to get a sense as to whether they are actually quite representative of the factor that they claim. Coming to the random simulation, and I think this is an incredibly useful way in which we test our strategies. So essentially, given a particular universe, it can be any universe, say large and mid, the top 90% of market cap, etc. You arrive at creating completely random portfolios. It could be on any dimension, right? It could be on the basis of number of stocks. So you can have from say 10 to 50 stocks, randomized simulations. It could be in terms of selection, of course, which of the 200, 250 stocks at any point of time that you bring in. And the third is, of course, on the weighting. So you can have on all 3 dimensions, run 1,000 by 1,000 by 1,000, and you get a whole range of simulations. And clearly, the overall distributions of that random would tend to be normal given the huge randomness that has gone into the input factor. And then what we do is we plot the percentile scores of our strategy, or in this case, we've just put NSE 500 total returns and Nifty 50 total returns to get a sense as to whether there is meaningful alpha creation, but more importantly, as the table below says. So what we do is the 60-day, on a 60-day, what is the percentage of times wherein the percentile of your strategy is above 75%? On 120 days, where is it above 75%? Obviously, you want to have more consistency in the signal. So anything more than say 60, 70, 80, 90%, obviously with greater time, in the near term, you will all be closer to 50%. I guess every strategy will be close to that. But as you go longer and longer is when you get to know whether the signal and the overall rebalance and the overall system that you bring in has got reasonable good chance to have decent alpha creation capabilities on a consistent basis. And lastly, we do think that possibly one key area which we like to explore a lot is in terms of the behavioral aspects. Obviously there are some companies which have such strong shareholders, who would back the company come time and again. And then there are those who are completely disgruntled and who want to flip out of them at every point in time. And one of the reasons, obviously, it can't be the only reason, is what their experiences in the past have been in the form of stock price returns, by and large. So what we plot out here is, for example, if you look at the disgruntled lot, these are the set of companies of a total universe, which are given less than or negative returns on a 5-year rolling basis. Okay, so effectively, for example, out here, close to more than 20% of companies of the particular universe have given at least 50% of the times, which means that if a stock has been there for say 20 years, at least for 10 years, so many rolling curves have been negative. Similarly, if you look at happy shareholders, that's been on a decline over a period of time. Now, how is it that we use this? One of the many ways in which we use it is that, for example, in a turnaround candidate, it could come through any signal or any framework. We would rather believe that a happy shareholder turnaround has a far more ability to continue to maintain its trend. Whereas in the disgruntled lot, there will obviously be many head fake rallies, etc. But in a disgruntled lot kind of a company, a turnaround, one will have to be a lot more suspectful of whether those trends can change, or whether there's a genuine change. Maybe there's a change of guard, there is a change of regulations, etc., that can completely change it, and which, of course, can make for a very happy ending. But by and large, we have found that focusing on the behavioral aspects can help improve the overall experience, both in terms of harvesting the signal as well as in terms of the experience to the overall end user. So I'll kind of stop here. Okay, this pretty much is the broader message that I want to give, which is that definitely super exciting to harness the power of Quant in India. There is definitely a lot of merit in going down the rabbit hole of Quant. However, I think blindly getting the models that have worked in the Western world and to believe that it will work here may not necessarily work because of the idiosyncrasies, liquidity factors, the overall market structure differences, etc., that I alluded to. More importantly, it is better to have a good testing framework which looks at more than one dimension. It's just not returns of one back test that should give a lot of confidence. And of course, there's a lot of questions which are still unanswered as I've gone through this journey, and I'm sure it's kind of never ending in terms of the rabbit holes that we'll all traverse together. A lot of data points that I've shared are available in these two, both on Twitter as well as in long form. With that, I'll kind of stop here. Happy to take any questions from Rupal and the audience. Thank you.
Thank you so much, Harish, for sharing your insights. Can I request you to just stop sharing so that you're more visible? Yeah, perfect. All right, so I'll probably start with some of the questions which I jotted down while you were talking, but just a reminder, for everybody who's online, if you have any question for Harish, please feel free to input that in the Pigeonhole link that we've shared with the invite. Okay, so super interesting presentation, Harish. Thank you so much for sharing your frameworks. Generally people are not very transparent in sharing their secret sauce. So thank you so much for that. My first question, which I found actually very interesting, all these Mr. Markets, so to say, feedback loops that you use. What are they telling us now? For the markets. I mean, I think Indian markets have been are very tricky right now. They've completely sort of defied a lot of these historical trends. And so, what are the feedback loops telling us?
So yeah, I guess the easier answer is it's a confused market feedback loop. Clearly on the valuation level, I guess however you slice and dice, I think they are at extremes. May not be in aggregate when we look at the index level, which is significantly weighted towards financials and a whole bunch of other sectors, which one can argue should be in whatever PE ranges one is comfortable at, right? But when we look at median levels, when we look at cohorts, when we look at breaking it up, I think on the valuation level, pretty much we are at the top edge, especially in an environment where the rest of the world is below its 25-year averages. We are standing out at a sore thumb. What is on the positive side clearly is on the sentiment level, and a lot of curves, if you look at it. So last June, July, I guess, maybe because of the fact that we had a 18-month run without any correction, and money making seemed so easy. Everybody was getting into and opening their demat account. So there were multiple indicators, including the feedback loops. If you go back, all of them kind of coincided. If you look at, say, the percentage of companies which had 99% lifetime wealth, that was at its highest reading that I'd seen. There are multiple other volume indicators that kind of gave a sense that we're today, if you were to look at it, a lot of those readings have moderated down quite significantly. So, and of course, wearing my fundamental hat and not necessarily a quant hat, over the last 12 months, we've seen one of the most brutal macro that we can, of course, can still surprise us. But given the fact that macros have become so mainstream, in my belief, I don't think macros can move the needle that much more. And therefore, having gone through all of these negatives, should one believe that there will be something which can surprise us significantly? I would think that possibly not. And therefore, I would say it is even Stevens from a valuation point of view, we are expensive. From a sentiment point of view, we are okay. We are not cheap, or we are not at distress levels, etc. So I would say we are somewhere in between. Is what the consolidated view of both of them, which means that possibly one has to do a lot more work than just hoping that one decision of sector selection or one decision of asset allocation will necessarily do the trick. So yeah.
Great. Which brings me actually to the second question. So the way that I understood it, it seems like a lot of these feedback loops go into broader asset allocation, understanding whether the breadth in the market is looking to stretched, etc. Do you have something similar, for example, to rotate within equities or within sectors? If you can share something around that, that would be great as well.
So we do have something similar. Of course, the challenges, I mean, at a very first principle level, so to speak, we are looking at two signals, right? By and large as quant. We are looking at one is mean reversion signal and second is momentum signal or the trend signal, right? Everything else is just an interplay between both of them. And obviously, the more aggregated you look, the mean reversion signal is possibly the more important one. And the more lower down the curve you look, the trend is the more important one, right? So valuations for a particular stock can stretch to infinity, theoretically speaking, whereas for a asset class, it's highly unlikely that the weight of the higher expectations itself will lead to it crumbling, right? With that caveat on, a lot of these data need not necessarily apply to the levels down, because obviously, at those levels, the trends or the from the mean reversion, you are moving more and more to trend, and therefore there is no exact rocket science to believe that okay here and here. What we do look for when it comes to sectors is slightly different, which is, for example, we look at the earnings share of a particular sector, we look at the market cap share, and then we look at the ownership share. And wherever there is a huge dissonance in each of these three variables, we do think that there can be a market reversion or a mean reversion trade possible. For example, I mean, one of the key sectors that we are overweight now, and we've shared this often, so I'm saying, is say the auto sector, wherein, if I were to look at the profit share over the last 20-25 years, it's varied from, if I'm not wrong, 1% to 11% of total top 1,000 profits. And currently we are at 2.5%. So for a cyclical sector, we do think that 2.5 can likely go to say 5-6%. Of course, there's a chance that can come down to 1% as well. But our view, wearing the fundamental hat, is that it's more aligned to go there. And then we look at the market cap shares, and then we look at the ownership shares, and then we kind of pull the trigger out there. So there is some math to it, but yeah, as with all investing, it's art and science. Can't totally codify and quantify everything out there.
Absolutely, absolutely. So another thing that I found very interesting that you mentioned was, this peculiarity, which is very specific to India, and about the F&O market, and day trading, or the trading volumes there, having this huge rise versus cash market not seeing that much of a liquidity. So of course it remains a big challenge, and it might eventually evolve. But at this point in time, do you see any way out, or sort of manage this from a quant perspective? That's point number one. And the second question, which is linked, is why do you think this trend is there, right? And in fact, what we've seen is that a lot of retail investors, given that F&O is generally not, an easy asset class, so to say, that it comes with its own complexity, we still see a lot of retail investors, going to that pocket in the market. So anything that sort of stands out for you of why we are seeing this very unique characteristic in Indian markets, and actually quite unique, when it comes to the F&O market in India?
So I guess that is a gambling streak in all of us as Indians, and with less capital, more leverage, dreams sold by so many. I guess it's an easy lure. I'm not saying that they are all bad, or I'm sure there are some very smart people out there trading. But I guess at some point, I mean, just as an aside, I had written an article about my home state of Kerala in terms of lotteries. And I was quite astounded that the amount of lottery tickets sold in Kerala. For example, my family is into the business of medicine. Okay, the amount of sales of lottery tickets, is more than 1.5 times the amount of medicines consumed in Kerala. Right. I mean, obviously, the state normalizes it for various factors of employment, blah, blah, blah. But without getting into the social nuances of it, I think given a chance to gamble and to believe that one can make it rich, the lottery effect does kick in as far as equities also is concerned. So, in some sense, people believe that just reading a chart or just reading something, it's a lot easier than going through a balance sheet, etc. So therefore, if I get it right, and some people will invariably, the odds will always get some people suckered in, and then of course we know what happens. But from an Indian perspective, coming to your first point in terms of the implementation of a lot of quant, I guess the way we look at it is one has to have a diversified book in quants, right? You can't be hoping to have a concentrated book and hoping to make that turn through the exchanges. The second thing that we've seen is, for example, one of the peculiarities that we've seen is that a lot of blocks happen in one exchange, and a lot of the non-blocks happen in another exchange. And therefore, when we do the test, we actually do the test on the exchange which doesn't see blocks. It's humanly impossible to get the volumes X of blocks, say 5 years back, etc. Right? And
Yeah.
therefore, this is, I think, a reasonably nifty way in which we can get a sense as to whether your strategy, because at the end of the day, as a quant trader, we can't participate in any blocks by and large, which
Right.
can be completely happening, and therefore you try and. I think the third that definitely can be used is a lot of skip strategies at the time of design of the quant itself, which don't necessarily look at signals of the near term, and therefore one has got a slightly longer time frame to execute some of these signals. Again, I don't think even we have cracked all of these, right? And as you rightly said, sometimes markets evolve on their own. If there is liquidity, if there is price, liquidity follows. So just that you want to try and ensure on your testing that at least some of these you have already thought about, rather
Yeah.
than going completely blind by getting and launching a fund which otherwise is not practical to execute on reasonable scale.
Sure. Sure. Another question that I had was, and this is something that we've always heard that, quants, of course, tends to be more backward looking. And, a lot of signals, for example, that you spoke about comes with this broader assumption of, we rely on mean reversion as one of the key indicators. So how do you think, or should, in fact, quants be tweaked in a cycle like, for example, what we are seeing right now? Where there are certain historical trends which have not really played out to the extent people would have expected, and given that quants tend to always have that historical reference point, is there a way to sort of make the quant models, I would say, a little bit more smarter, enhance them? In fact, should we even enhance them after every cycle, because every cycle is different? I of course have my own view, but would love to hear your view.
No, so I don't think changing or curve fitting it, to use the most harsh word, after every cycle, to fit in new factors or to fit in new variables is
Yeah.
really the approach that will work out, because for sure each cycle is different, right? And at the end of the day, as they say, it may be different, but it rhymes in some ways. And the idea is to find that frequency which is rhyming, rather than finding out the dissonance points which isn't, because
Yeah.
I mean that is a path of no return, because you're going to constantly keep finding signals that are always going to surprise you on the upside. I'm saying from a mean reversion point of view, and therefore you need to see which are the ones that are. And what I've generally found is the behavior, and this is something, I forget the name, one of the founders of Renaissance has this wonderful presentation wherein they had done this entire analysis on drawdowns and on the emotional aspects of investing. And they basically found out, I mean, I forget the time horizon, but I think it was some 200, 300 years of data of the Western world, wherein they found that the actual emotions of greed and fear are time immemorial. And that, to my mind, is the biggest mean reverting signal. So, right, if you're going to see mainstreaming of greed and fear in either direction, it is unlikely to last. Of course, I mean, markets will surprise you even there, but there's a good chance that you are more better off focusing on those aspects than looking at aspects purely from a valuation lens of view, which can be normalized through a number of ways, right? We've all seen and read reports of earnings yield. You can tweak a number of things to get the output that you want. But the emotional aspects, the mainstreaming of this is something which I'm not sure changes with time, and therefore I would look at those as better markers.
Got it. I'll just quickly ask you maybe one last question before we, open it up for wider Q&A. In fact, linked to the earlier point that you made around, this greed and fear. do you think this is probably the biggest market anomaly, even or behavioral anomaly that you see even in Indian markets, or through your experience across cycles, do you think there's something which Indian markets could be more better represented when it comes to behavioral anomalies and sort of tapping that through quants?
No, so I think again, please view my response with a lot of salt. See, the reality is we are what to say, when it comes to efficiency of markets, I don't know whether to look at it positively or not. There's a reasonable amount of uh, information asymmetry, etc., that comes through in India, right? Without going through the obvious things, right? And therefore, there is the wisdom of the market, which already knows, and maybe as investors who've got a particular process, etc., we may be one of the later ones to know what the insight is. And therefore, to my mind, I think the wisdom of the crowd is a lot more potent in India. uh, I mean, not that I've done a study across markets to say it, but purely from my experience, I know that the tape says something much more than fundamental and what we can think of, primarily because of the fact of the reasonable porosity that we've seen. And while it is improving, etc., I think as a job, as a practitioner, our job is to use the signal where it is, through the aggregate wisdom of the crowds, and basic idea is there is a certain wisdom of crowds, but when it becomes a mania of crowds, if you're able to identify the two, I guess your job is a lot easier done. I mean, in theory, it seems easy, but then practice, of course, we all go through our struggles.
Sure. Makes sense. All right, so we'll probably start, the wider Q&A. Again, a reminder, if you have any questions, please feel free to put them in the Pigeonhole link. We have a few questions here, so I'll quickly start with the first one. How many factors do you input in your quant systems? What factors you think are working in the Indian market currently? And what factors you think are robust even in the longer term?
So I think there's a lot of academic papers out there on the Indian investing. I would strongly urge the participant to go through it. And pretty much, I would say most of the factors in the Western world seem to have been proven to work in India as well, from an academic literature point of view. I guess the point is clearly that there are cycles, and what works now need not necessarily work a few times from now. In terms of what we use, I guess we use factors on the fundamental side, on the quality. We use factors on momentum. We also use factors on valuation. I mean, so this is like a laundry list of all factors, right?
Yeah.
I don't think there is anything that we are against it, but generally what we've found is that combining them to create a holy grail kind of a thing, I mean, sounds good on paper, but I guess the results need not necessarily come true. So therefore, we would rather look at, say, one or two key signals, and then to use a weighing schema, which can be using some other factors as an input rather than using it as a selection. That typically works better in our sense. So yeah, I think all factors, there have been reasonable reports to suggest that they work in India.
Got it. Okay. The second question that we have here is, cycles like these see redemption stress on the fund. Does the quant model take into consideration any kind of redemption stress?
I think it's too nascent for us to believe. We haven't even started out, so to believe redemption. But yeah, it's a valid point. I guess at the end of the day, quant is reasonably higher churn. I mean, it's all relative, right? Nobody's saying that we churn every day or every month, etc. But compared to where we otherwise are on fundamental signal, the churn intensity is much higher, and therefore you want to be in the more liquid space. And once you're there, then I guess redemption. Otherwise, of course, it adds to a toll. Nobody can plan for it entirely. But yeah, if you're on the reasonably liquid end, I think by and large, so far at least, we haven't seen or heard of anything on those counts.
Sure. Okay, so another question that we have here is when adding more equity exposure, what would be your key consideration? Would you actually start with sector level calls or stock selection, or would it be more factor calls?
Again, from our perspective, it is more sector than stock. As far as so, at least we haven't reached a stage where we want to combine everything. So a top down has a quant layer to it, but the bottom up layer is to the discretionary of the fund manager. We haven't yet combined both FAQ and QA to get to one product yet.
Sure.
Maybe that is the endeavor at some point, but for now, it is more at the discretion, which means it's more top down. Then it becomes sector, then stocks, etc.
Got it. I'll probably take just one last question, given we are at the hour. Any insights on how we can systematically capture emerging longer term trends? Because again, generally quant models come with that historical reference. So any new structural tailwinds that are emerging in the market or sector, is there a way to systematically capture that?
So part of the yeah, it is an interesting thought. But see, I guess there is a lot of alternate data that's starting to come around, right? I mean,
Correct.
For example, Twitter polls, Twitter data points. You've got, thankfully, India is going a lot more digital in a lot of its transaction intensity. And I guess those data points, while it's too early for us to have any history now of a lot of those data points, but with time, if your model is capable of using those exogenous variables along with, say, the typical 5 or 6 factor variables as an input, I guess the results, I would imagine, should be, better, hopefully, than what we are. So I guess that will be one way in which we can go about devising it. But yeah, it's something definitely for one to think about.
All right, I'll leave it here. Thank you so much, Harish, for your time today. Thank you everyone for joining, and I hope you can join us in the following session. We have the second session on Wednesday. Ashutosh from Nippon will join us to address one of the key questions, is the role of valuation too overstated in quant models, in asset allocation, and in long-only equity portfolios. Hope to see you all then. Thank you so much. Have a lovely evening. Bye.